Good evening, everybody, and happy weekend to us all. Tonight, we're going to round up our discussion on investment appraisal or investment decision or capital investment decision. In the introductory class, we talked about the definition of investment appraisal, that is capital investments, and we said this is also known as capital expenditure or capital budgeting. That this capital investment decision, it involves the process by which an organization commits its funds into a long-term project. That is, projects that span over one accounting period, such as construction of bridges, roads, dams, refineries, power plants, lands, and buildings, and so on and so forth. So ordinarily, companies should pursue investments. Companies should pursue investments that will increase the value of the business and which will invariably maximize the shareholders' wealth. One thing about financial management is about maximization of shareholders' wealth. But because of limited resources to finance quite a number of projects, there will be need to ensure that the resources at hand is judiciously put into the right use that will yield the appropriate return within certain period. And based on this background, there is a need for investment appraisal so that we won't just use our resources like that. We use our resources as expected, and the shareholders, those that are giving us the money, will be happy in return. And that is the reason for appraising investment opportunities before we embark on them. So there are various approaches to this investment appraisal. We've looked at the discounted and non-discounted approach. We've looked at issue of payback period. We've looked at accounting rate of return. That is under the non-discounted approach. Under the discounted approach, we've looked at net present value. We've looked at internal rate of return. In the more advanced class, such as SFM, there is more to it. We can have issue of adjusted present value. We can have issue of modified internal rate of return, and so on and so forth. So to determine the viability of projects, that will help the company achieve its target objective among competing projects, there is a need for investment appraisal. And that is the reason why this topic is important, because as financial managers that you are, as chartered accountants that you will be soon, as you use your knowledge in your organization, you'll be engaged in decision making. You will come across scenarios that will require your professional judgment on what an organization is to do part time and the reason for this. So we looked at issues of NPV. We've looked at issue of internal rate of return. We've looked at payback period, accounting rate of return. We've looked at their advantages and disadvantages, even though some of them overlap. to be same for one another. And we've solved questions that involve all this. And we take it further to look at issue of taxation in investment appraisal. We looked at issue of taxation in investment appraisal because when a company incurred qualifying capital expenditure, the company is entitled to claim capital allowance on the qualifying non-current assets. So capital allowance, we said, is an allowance granted to companies for incurring qualifying capital expenditure. For incurring qualifying capital expenditures at specified period of time. So taxation in investment appraisal will address issues such as tax liabilities, will address issues such as tax savings, will address issues such as timing of the cash flows. So when we talk about tax liabilities, this is calculated by multiplying taxable profits with the company tax rate. And when we talk about tax savings on capital allowance, this is calculated by multiplying capital allowance with the company tax rate. We looked at all these and we talked about types of capital allowance. We said in that class that for the purpose of investment appraisal, the types of capital allowance include initial allowance, annual allowance, balancing charge. Initial allowance is an allowance that is claimable once in the lifetime of the assets. And the annual allowance, this is granted every year until final disposal of the asset. And we have the balancing allowance that this will arise when the tax written down value from the preceding year is higher than the sales proceed at final disposal of the asset. And we have the balancing charge. This arises when the tax written down value from the preceding year is lower than the sales proceed at the final disposal of the asset. This is just trying to reiterate what we've discussed in the previous classes. And we said we have method of calculating capital allowance. We said we have method of calculating capital allowance. We said there is a straight line method and we have reducing balance method. Straight line method and reducing balance method. We showed examples on how to compute all these. And also, we looked at a question whereby for you to determine when to claim capital allowance, some questions will tell you that you have to claim capital allowance in the relevant year. Some questions will tell you claim capital allowance in arrears. So capital allowance can be claimed in the relevant year, either in current year or in arrears. The question will make it clear. The question will make it clear. Now, the another point is this. Why do we calculate capital allowance? We explain this, that capital allowance are used to reduce taxable profits and final reduction in tax liabilities. Because when you purchase certain assets, there will be tax incentives to encourage investors to purchase such assets. So part of the tax incentive is the tax savings that you get purchasing such qualifying capital expenditure. And we show a format on how to compute the capital allowance and tax savings. We show a format on how to compute these. And also, we show a format on how to compute net present value, where you are giving question that requires you to check your inflow and your outflow. And also, we went further to look at issues that have to do with inflation in investment appraisal. Inflation in investment appraisal. And in that class, we said inflation may be described as general increase in the prices of goods and services, leading to what? A decline in the value of money, leading to a decline in the value of money. So when we talk about inflation, inflation is a fall in the purchasing power of money. And inflation should be considered in ascertaining project viability. If the cash flows arising from the project will be affected, will be affected by inflation. And that is why we are coming up with the issue of inflation in investment appraisal. And we said there are basically two types of inflation. You have general inflation and specific inflation. The general inflation is an inflation that affects the economy as a whole, while specific inflation are inflation that affect certain variables in a project, such as the sales, the revenue, and so on and so forth. And we take it further to we took it further to look at issues of cash flows. We said we have two types of cash flows. We have the money cash flows, we have the real cash flows. We said the money cash flows are cash flows that incorporate the effect of inflation. They are cash flows that incorporate the effect of inflation. So these money cash flows are inflated cash flows. They are inflated cash flows. So we said in that class that unless otherwise stated, all cash flows are assumed to be what? To be money cash flows. All cash flows are assumed to be money cash flows. And we also talk about real cash flows, that these are cash flows that do not consider the possible effect of inflation. They are cash flows that is stated in terms of current year prices, today's prices, year zero prices, or year one prices. So these are the examples of cash flows. And we talked about the effect of inflation on discount rate. Effect of inflation on discount rate. And we said we have two forms of cost of capital. We have money cost of capital. We have real cost of capital. We have money cost of capital. We have real cost of capital. Real cost of capital. And the money cost of capital, we said, is also known as the nominal cost of capital. And we said money rate of return is the cost of capital that incorporates what? The possible effects of inflation. And money cost of capital is used to discount what? Money cash flows of a project. Money cash flow of a project. And I said note in that class that except otherwise stated, always assume available cost of capital to be money cost of capital. And we said we have the real cost of capital, that this is the cost of capital that does not incorporate the effects of inflation, does not incorporate the effects of inflation. And it is the cost of capital that is expressed in real terms. And we show a formula put forth by Fisher that is known as the Fisher effect formula in terms of inflation. And we show the equation to be 1 plus m equal to 1 plus r multiplied by 1 plus I. And we said m is what the money cost of capital in that equation, and r is the real cost of capital, while I is the general inflation rate. And I gave some general rules in that class to say that cash flow stated in money or nominal terms must be discounted using money cost of capital. And we say cash flow stated in real terms must be discounted using real cost of capital. That's money cash flow should not be discounted using real cost of capital, and real cash flow should not be discounted using money cost of capital. All this we stated in that class. And I also add to say that where cash flows are stated in year one prices or first year prices, inflation should start from where? From year two. And where cash flows are stated in today's prices, year zero prices, current year prices, inflation should start from where? From year one. All these we looked at and we solved examples followed by assignments. Followed by assignments. I should go to the group chat to evaluate the number of persons that submitted the assignments. I know it will be it will be to it will not be encouraging because if I should have many response from the assignments, even me too, I will know I have. But let me go and check. Let me go and check the number of persons that attempted the assignment. Let's see the number of persons that made attempts. February 9th. The number of persons that made attempts, they are not much. Maybe you've made attempt in the secrets and you didn't send it to me, fine. But the point is not until you send it to me. Make sure you solve it, do it. That is my own concern. If you don't send it to me, you are saving me less work. So you are not giving me work to do. Because once you send it to me, I need to check what you've done. So if you don't send it, that is good. At least I have less work to do. I don't have to check anything. But it is good for you to solve assignment questions. It is the secret to pass this paper. The secret to pass ICANN and move forward. But when you don't solve, I will not say the other parts. So that is it. So tonight we are going to round up this class, this topic with this question that is all encompassing. It's a question that includes inflation, taxation, and working capital. So this question we're going to solve, and I'm going to back it up with assignments. If you like, solve. If you like, don't solve. But the point is, from all we've discussed, it is expected that the objective of this class is that by the time we are through with this topic, you should be able to solve any question you see that involve investment appraisal, that involve taxation, inflation, and issues of working capital, at least 80%. Yes, 80%. That is the objective. If you followed the instructions very well. So that is the expectation. But if you have not been solving, you will have complaints to tell. So we're going to solve this question now. Can somebody read? I've taken my time to type the question again. Yes, instead of using the document I forwarded earlier on. So I took my time to type it again. So somebody will tell me they don't have time. Even me too, I don't have time. But once I say that I want to teach, it's good I do it well. So if you say you want to learn well. So can somebody read, please?
Washington PLC is considering a project whether or not to commercialize an innovative muzzle toning device, MTD in bracket, that will be used in the treatment of sporting injuries. It is expected that the commercial life of the MTD will be 4 years after, which technological advances will bring more sophisticated devices to the market and sales of MTD will fall to virtually zero. 8 million naira has been spent in developing and testing the device over the past year. Initial market research has been conducted at cost of 2,500,000 and is due to be paid shortly. Information on future returns from the investment has been forecast to be as follows. All figures assumed to be correct. Shall please scroll up a bit. Okay. Selling price inflation rate and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. Fixed costs represent incremental fixed production overheads, which are wholly attributable to the project. The production equipment for the new device would cost 120 million, and as additional initial investment of 20 million would be needed for the working capital. The equipment is expected to be sold at the end of 4 years for 10 million naira when the production and sales cease. The average general level of inflation is expected to be 3% per year, and working capital would experience inflation of this level. Capital allowances and brackets tax allowable depreciation on a reducing balance basis could be claimed on the cost of equipment. Profit tax of 30% per year would be payable 1 year in arrears. A balancing allowance would be claimed in the fourth year of operation. Washington PLC has a real cost of capital of 7.8%. You are required to A. Calculate NPV, IRR, and discounted payback period, 22 marks. B. One of the basis of NPV, advise if the project should be considered, bracket 3 marks. Okay, sorry. B. On the basis of NPV, advise if the project should be considered, bracket 3 marks. C. What are your assumptions on the calculation above, 5 marks?
All right, thank you very much. So this question is adapted from ACCA, and it's what we can solve. And somebody have attempted it, and I can see good level of understanding from the person. 2 persons, yes. 1 male, 1 female. Yes. So the female didn't post her onto the group. Yes. So we're going to see. It's not a difficult question. Yeah, somebody say, we always say it's not difficult. Yes, it's not difficult. That is the mindset you should carry. It's not difficult. So looking at this question, we'll start with the workings, but let's analyze. Let's see what the question entails. Let's see what the question entails. Now, let me go over the question again. Then I will ask some questions. The Washington PLC is considering a project whether or not to commercialize an innovative muzzle toning device that will be used in the treatment of sporting injuries. It is expected that the commercial life of the MTD will be 4 years. Take note, it means the lifespan of the muzzle toning device will be what? 4 years. 4 years. Take note of that. Take note of that. Will be 4 years, after which technological advances will bring more sophisticated devices to the market, and sales of MTD will fall to virtually zero. 8 million naira has been spent in developing and testing the device over the past year. Please, any question? Jesus baby.
I can't see the screen, sir.
Okay. Is she the only one?
Yeah, I can see your screen.
I can see your screen, ma.
Please check your
Right.
network.
Let
I
me
can see your screen.
reshare again. Let me reshare again. So it is expected that the commercial life of the muzzle toning device will be 4 years, after which technological advances will bring more sophisticated devices to the market. And sales of muzzle toning device will fall to virtually zero. 8 million naira has been spent in developing and testing the device over the past year. What kind of cost is this? This 8 million naira.
Sunk cost.
It's some cost.
Some
Some
cost.
cost.
Yes, sir.
Yeah.
It's not
It is not
relevant.
relevant. It is not relevant. See the English. It is not relevant. Has been spent. English. It is not relevant. You know, we talked about relevant cash flow for capital investment decisions. We talk about cash flows that are relevant. We talked about variable costs. We talked about fixed costs. We talk about depreciation or amortization. We talk about interest. We talk about incremental cash flow. We talk about working capital, opportunity cost, sunk cost. So based on this grammar, that figure is not relevant because when students are in the exam hall, they begin to think everything is important. This is not relevant. It's just an information. Initial market research has been conducted at a cost of what? 2,500,000 and is due to be paid shortly. What kind of cost is this? What kind of cost is this?
This one is relevant.
Is relevant?
Yes, sir.
Yes,
Yes, sir.
Say it's relevant. It's not relevant.
It is
But
relevant because it has not been, it has
They
not
say
been paid yet.
initial cost, initial market research.
I
So
think this course is under research and development course.
so is it relevant?
No, sir.
It's
No,
not
sir.
relevant.
Not relevant.
It's not relevant. This is a sunk
But,
cost. This,
but it's saying something here that that is due to be paid shortly, meaning that it has not been paid yet.
well, it's due to be paid shortly. Yes, it's due to be paid shortly. But the activity is not futuristic. It's a past activity that have occurred. So what we are looking at issues, we are looking forward. Issues that will be relevant to the organization, to Washington PLC in future. So the issue of initial market research is a sunk cost. And these sunk costs, they are past costs that have already been incurred. They are historical costs, which have no impact in making future investment decisions. And the examples include development costs, market research costs. So this cost is irrelevant cost and should be ignored. Should be ignored. So the fact that the put is due to be paid shortly. The shortly can be the next 2 minutes, even before we begin to appraise the new device. The new device. So it is not relevant. It is not relevant. So looking at this table, we have demand. This demand is in which measurement?
Units.
Right.
Fine.
It's in
Is in
units.
units. Is in units. I know why I'm asking this question. Some students will walk to the exam hall. They will not check those things in brackets. They will just assume their monetary value and begin to use. So please, you check very well. Demand is in what? Is in units. It means in year one, you're expected to get a demand of 20,000 units. In year two, 70,000 units. In year three, 125,000 units. And in year four, 20,000 units. Now, selling price in current price terms. See that grammar? Selling price in current price terms. You can see the selling price. Who can tell me the interpretation of this value in bracket here? What is
Without
the interpretation?
inflation, real cost.
Okay, okay, okay. We are coming there. But is this value, this naira per unit? What is the
That means
interpretation?
1 unit is 2,000 naira. A unit
Very,
is 2,000 naira.
very good. It means a unit is 2,000 naira. Naira per unit. You understand? A unit is 2,000.
Mute your mic after talking.
So a unit is 2,000 naira. 2,000 naira. 2,000 naira. I'm coming back to the issue of current price terms. Now, for variable cost in current price terms, the variable cost also, it means the variable cost per unit is what? For year 1 is 900, year 2 is 1,000, year 3 is 1,020, and year 4 also 1,020. 1,020. Now, fixed cost in current price terms. Fixed cost in current price term. What is the interpretation of that value in bracket?
It's in yearly.
Yearly.
Evenly.
Annually.
No. It means that 10, those 10 you are seeing, they are in millions, right? That is 10 million per year for fixed cost, 10 million per year, fine. Because sometimes when you go to the hall to interpret some of these things, it become another issue. As I'm taking my time to say this is it, this is that, so that you know how to look at it. You know, during the exam, the spirit is in another way, but now, anything you need to know it now. Not when the exam is 2 weeks, you'll be jumping up and down. So now, fixed cost in current terms. Fixed cost in current terms, the value 10, 10, 10, 10, based on what is in brackets, you can see naira M. It means 10 million per year. 10 million naira per year. 10 million naira per year. Now, going back to the issue of current price terms. We explained this in our last class. Issue of under the issue of inflation. Yes, under inflation. When we talk about current price terms, even today I've mentioned it. I've mentioned something like that. When we say current price terms, what are we referring to? It
In
means
today's price,
very good. Today's price. In today's
It
price.
means the inflation is starting from year 1.
Okay, fine. Inflation will start from year 1. So in this today's price, is inflation incorporated in it?
No, sir.
No, sir.
Fine. 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 The
It is
answer is no.
incorporated.
Okay, Mr. Andrew, can I get your view now?
Yes. Because the values are in real time. So they said cash flows that are not affected by inflation. It is not incorporated. Yes.
Okay, fine. Inflation is not incorporated. So inflation is not incorporated. So let's take it further now. Let's take it further. That selling price inflation rates and fixed cost inflation rates are expected to be 5% per year. What is the interpretation of this?
So I think the interpretation is that selling price, the inflation rate will be 5%.
Okay, selling price inflation will be 5%. Is it, how are we going to solve it? For year one,
How we
what
are
we
going
have,
to solve? Year one is the selling price multiplied by inflation rate. Then year two is selling price, then the inflation rate. I don't know how to explain it, but I think we've done it before. Then that's 0 point, as in 5% is 0.05. You add it to 1, it will be 1.05. In the year two, the 1.05, you square it by 2. Then use it to multiply the selling price. You get the year two cash flow.
okay. Yes, that
I
is
don't
very
know.
good. You know, you are correct. It's, don't say you don't know. You're a professional.
Okay, sir.
The difference between you and me is time. It's time. Very soon now. You, so it's time. You get there now. So it is correct. You are correct. So in year one, 5% based on inflation, it will be, because there will be an increase. Inflation effect on 2,000, the selling price of 2,000 for year one. The inflation effect, since it's 5% increase, 5% inflation, it will be what? 5% is what? 0.05. So if you want to do it the normal way, maybe the primary school way, you can say 5/100 multiplied by 2,000. What will be your result? What will be your result?
100.
Fine. So you now say
100.
100 plus 2,000. It will be what? 2,100, isn't it?
100. It is.
So
Yes, sir.
in year one, that will be your selling price. That will be your selling price. But me, I will not do it that way because I know inflation is increased. I will just say 1 plus 0.05. That is 1.05 multiplied by 2,000. Can you compute? Where's your calculator?
2,100.
So it will be 2,100. So whichever way, you know, this is exam. You do what you know you can get easily. Yes. What you know you can get easily and you still get the right results. You follow the
So
approach.
can you repeat that statement you just made now on how we got that 2,100? Because the previous way I was using to multiply is that 2,100 multiplied by 0.05 will give me 100. So there was something you just said now which I didn't get clear because my network threw me out, so I can't get you very clear at all. So if you can help me.
All right, fine. I get you, sir. So I said another way you can do that is to say since 5% is 0.05, 1 plus 0.05 is 1.05. So 1.05 multiplied by what? 2,000. We give you what? 2,100. Do you get that, sir?
Yes, I do. Thank you.
All right. So for year one, the selling price will be what?
2,100.
Fine. For year two, the selling price will now be what? For year two.
1.05 is the power 2 times 2,000. 2,205.
No,
Sorry.
I got 4,100. I don't understand.
Yeah, it's supposed to be 2,200, not 2,000.
2004-26.
Fine, 2004-26. We are going to solve it, or we are just doing analysis. You know, some people might be scared. Is this how we are going to do it? Don't worry.
Yeah.
We are just doing analysis. We are going to show it. So for year 3, what will happen? For year 3.
The same thing. 1.05 raised to power 3 multiplied by 1,600 to give you 1,852, sir.
All right, thank you very much. So that is that. You can do the other year by yourself. Let's move on. The statement says that selling price inflation rate and fixed cost inflation rate are expected to be 5% per year. Variable cost, if I'm coming back to the fixed cost issue, I'm coming back there, but let's move on. Variable cost inflation is expected to be 4% per year. So for variable cost too, what will happen? For variable cost, what will happen? Same approach. That is 1.04 multiplied by what? Multiply by 100 for year 1. For year 2, 1.04 to the power of 2 multiplied by 1,000 for year 2. In that order. In that order. So now, let's read. Fixed cost represents, see this statement, fixed cost represents what? Incremental fixed production overhead, which are wholly attributable to the project. You know, in our understanding, we say fixed costs are not relevant, right?
Yes.
But in what instance will fixed costs be relevant?
When it is incremental fixed cost.
Very good. I recall in that.
When it is a project specific cost.
Yes, very good. Yes, when it is project specific. So in that last class, I said these fixed costs. I remember my statements. I said these are costs that have no sympathy for activity level. That irrespective of number of units produced, fixed cost does not change. So it is an irrelevant cost and should be ignored, except it is what? Direct or incremental in nature. So in this case now, is fixed cost relevant or not relevant?
Yes,
relevant.
It is relevant.
It is relevant. Fixed cost is relevant. So, and the statement on fixed cost, that fixed cost is to be affected by inflation by what percentage? By 5%, isn't it? Yes, see, it's selling price inflation rates and fixed cost inflation rates are what? 5%. So same approach. Your fixed cost value is what? Is 10. So working based on thousands now. Yes, it will be 10,000 multiplied by what? 1.05 for year 1. For year 2, 10,000 multiplied by 1.05 to the power of 2. For year 3, 10,000 multiplied by 1.05 to the power of 3, in that order. In that order. So let's go further. Let's take it further. All those joining the class late, I'm seeing you. I'm observing. So now, the project, the production equipment for the new device will cost what? 120 million. This 120 million can be termed as what?
Initial outflow.
Fine. Initial outlay. Production equipment, yes. And an additional initial investment of 20 million will be needed for working capital. For working capital. That is as at the beginning of
additional cost.
Yes, as at the beginning of the business. Now, this working capital, I want to talk about it. This working capital, note, it is the fund used for day-to-day running of the business, and it is released once in the lifetime of a business. That is why, if you recall the last example we treated last week, as at the end of the project, it became what? An inflow. Do you recall? So now, this working capital, as at year 0, it will be made available. When the project is to elapse, it will come back as an inflow. But where there is the effect of inflation, the 20 million that was released in year 0, will it be the same as at the end of year 1 if
No.
there is inflation?
No, sir.
That 20 million also, as at the end of year 2, with the effect of inflation, will it be the same?
No, sir. It
No.
increase, sir. No, sir.
So when you see inflation affecting working capital, what you will recognize is the inflation effect, the addition of that inflation. What addition is inflation bringing to 20 million? That is what you will recognize as incremental working capital. It means that if I should have 20 million in year 0, as at the end of year 2, what will be my incremental working capital? What is the inflation rate now in this question on working capital?
3%.
Fine, 3%. 3%. So as at the end of year 1, what will be the inflation rate? That is 1.03 to the power of 1 multiplied by 20,000. What will be the result?
20,600.
Are you going to recognize the whole of that 20,600 in year 1?
No.
What will you recognize?
600, sir.
Sir, please explain to me.
Year 0 is 20,000. Year 1 is 600. I'm sorry, sir.
Very good, very good. So it is the incremental that has resulted from inflation that you recognize in year 1. In year 2, what will happen? In year 2, 1.0.
Auntie Joy, mute too.
So in year 2,
we will record 1,218 naira.
So what is the incremental comparing that with year 1?
naira.
That is what you will recognize in year 2.
Sir, I did not get to.
Don't worry, you will get it. I will solve it now. Don't worry.
Okay.
So that is just by way of exposing us to. Then we need to solve for our tax saving on capital allowance. We need to also solve for that. Then if you look at the question, they are saying something. Let's say that capital allowance on reducing balancing basis will be claimed on costs of equipment. Profit tax of 30% per year will be paid 1 year in arrears. A balancing allowance will be claimed in the 4th year. Washington PLC has a real cost of capital. What is real cost of capital? What is real cost of capital?
Real cost of capital is the cost that did not incorporated inflation rate.
Fine. So based on what we are solving, do we have inflation incorporated in our cash flow?
No, sir.
Yes.
The answer is yes, there is inflation in our cash flow. And that is why we are adjusting for inflation. So where I'm driving at is, since we have real cost of capital, can we match our real cost of capital with our cash flows, which are money cash flows?
No,
No,
sir.
sir.
We need
Have
to
to
adjust
change
for money,
Yeah.
money cost
Money
of
cost
capital.
of capital.
So that is where the effect of Fisher's formula comes in. So that our formula where we say 1 plus m equal to 1 plus r multiplied by 1 plus I. We'll use it. We'll convert this real cost of capital to what? To money cost of capital, for us to be able to use it. For us to be able to use it to discount our cash flows. So let's show the workings on the screen now. So we just show the workings. The workings are the main thing. Then we'll arrange our MPV. So now, workings. I know everybody that have joined late. I didn't make the class open, so as you are coming, I'm admitting you. So workings 1, we said what? The selling price, they are in current price terms. So for us to get them in the money terms, what are we going to do? For us to get them in money terms, what are we going to do? We adjust for inflation. We adjust for inflation, and the inflation effect is what? 5%. 5%. So we have it this way. We have sales. Let's come up with it. Sales. We have year. We have what? How many years are we looking at? The project lifespan.
4 years.
4 years.
4 years.
4 years. Now, the selling price, as given in the question, is what? Selling price, given in the question, is what? For year 1, 2,000. For year 2, 2,200. For year 3, 1,600. And for year 4 is what? 1,500. Now, what is the inflation rate?
5%.
5%.
Inflation
5%.
at 5%. Inflation at 5%. Inflation at 5%. So in year 1, inflation at 5% will be what? 1.05 to the power of 1. And this will give us what? 1.05 to the power of 1. So we'll have it as what? Once we multiply,
2001.
we have it as
2,100.
incremental selling price. Incremental selling price. So we have it as what? 2,100. In year 2, it will be what?
2,426.
5.
To the power of 2, it will be what?
2,426.
426. For year 3, it will be what?
1,852.
852. And for year 4 to be what?
1,823.
So we have it as 1,823. Now, these are the selling price. The units we have is what? Our units demand in units. For year 1, 20,000, year 2, 70, year 3, 125, and year 4, 20. So if you multiply this, your selling price has been affected by inflation, by your demand in units. What are you going to have? The demand in units, we have 20,000, right? For year 1.
Yes.
For year 2 is what? 70,000. For year 3, it's what? It's 125,000. I'm not mistaken. And for year 4 is 20,000. For year 4, 20,000. Fine. So when you multiply, what will be your total sales?
42,000 for year 1.
That means, okay, you are removing the other zeros, right?
You round
Yes,
it.
sir.
Yeah.
Okay, fine. So it's actually so you are removing those 3 zeros. Please, everybody take notes. You are suspending those 3 zeros. So for year 2, it will be what? The 169. I believe we get what we are doing.
20.
That is,
Yes, sir.
let me show it because I know I will get question very soon. Let me show it. This one will be 2,100 by 20. You have this. You understand? So I'm removing these zeros here. Just multiply by 20. This one will be what? 2,426 multiplied by what? By 70. You have 169,820. These total sales here will be 1,852 multiplied by what? 125. And your answer will be what? The outcome will be what?
31,500.
231,500. The total sales here will be 1,823 multiplied by what? By 20. And your answer will be what?
36,460.
36,460.
Any question based on this
36,460.
work? Based on this work 1? Any question?
Sorry, sir. How do I arrive at the 1.05? I know the
Okay.
0 is the percentage, but then the 1.
Okay. So once there is an increase, if 500 will increase by 6%, it's just for you to add 1 to 6% in decimal. Then you get the increase. But I now explain that you might not want to go in that route. You can adopt another route by saying that 5% of what? Of 2,000, we give you what? We give you 100. 100 plus 2,000, we give you what? 2,100. But as far as financial management, strategic financial management is concerned, the understanding is once there will be an increase based on percentage, for you to get the percentage increase, just add 1 to that value of to that percentage, so that 5%, 6%, and multiply by the gross sum that you have, you get the overall result. You understand? So instead of going through the route of saying 5/100 multiplied by 2,000, you get the increase of 100, add 100 to 2,000 to get 2,1. We just work in that line. Once I know I'm increasing by 5%, it's just to say 5% is 0.05 plus 1, 1.05. But if that is not okay by you, you can work the other way around. The ultimate thing is for you to get your answers right. Yes, there's no penalty for doing it that way. So the
That
goal,
means it's not supposed to appear in a percentage, or because
sorry, I'm not getting you.
it's okay.
No, speak out.
Because when I saw your solving, I saw you presented it as 1.05 raised to power
Yeah.
of 1. So
Yeah.
we didn't put that, or we put the amount itself.
Yes, you can just solve somewhere and bring your incremental selling price 2,100. Yes, you understand?
I do.
Yes.
Thank you.
Yes, I'm just showing it because if I begin to bring figures without showing the steps.
Yeah, that's true.
Yes.
Thank you.
All right. So the next is the issue of variable costs, because variable costs likewise are variable costs in current price terms, and we have inflation value for them. The variable cost inflation is expected to be 4% per year. 4% per year. So the variable cost. Variable cost. We also have 4 years. We have year 1. We have year 2. We have year 3. We have year 4. The variable cost given in the question is what? Variable costs for year 1 is what? Variable cost for year 1 is what? 900. For year 2 is what? For year 3 is what? For year 4.
1,020.
So the inflation is at what rate? Inflation is at what rate?
4%.
4%. So as at year 1, because they are stated in what? In current terms, it means the inflation will commence in year 1. So we shouldn't have issue with that interpretation based on our last class. So now, inflation in year 1, this will be what? 4%. Since it's inflation, there will be an increase to the power of 1. The result will be what?
936.
936.
936. In year 2, it will be what?
1081.6.
That is
82.
In year 3,
1147.
1147. And in year 4,
1193.
1193. So this is incremental variable cost. This is incremental variable cost. Incremental variable cost. Yes, what is the question, sir?
If we are consistent with our approximations, I hope no issue. Like the numbers after decimal.
No issue, sir. Once
Okay.
you are consistent, yes, there is no issue. Yes, Madam Ineka,
Hello, sir.
I'm with you, ma.
Sorry, please. I'm a bit confused now. So you said that if inflation is given, like if you are giving year one, inflation start from year two. If you're giving year zero, inflation start from year one. Now we are starting from year one already.
No, ma.
Our question year zero was not given.
This is it, ma. We explained in our last class that where cash flows are stated in year one prices or first year prices, inflation should start from year two. Where cash flows are stated in today's prices or year zero prices or current year prices, inflation should start from where? From year one. Now, in this question, cash flows of selling price or variable cost or fixed cost are stated in which term?
Okay, sir. Current price.
Current
So,
price.
so where they are stated in current price, inflation should start from which year?
Year one, sir.
Yeah,
Okay,
one.
sir. I was thinking it must be like year zero before. Okay. Thank you, sir.
Right. So the incremental variable cost, we have them there. Now, these variable costs must be associated with what? Your output to get your total variable cost. So our outputs, that is the demand that we have. Let's say demand. Let me use demand in units. Demand in units. So now, what will be the variable costs? The total variable costs. But our demand in units, let me make it this way. Demand in units, let's say, that is, we are suspending the 1,000. That is why I'm trying to show it this way. So demand for year one is 20. For year two is what? It's 70. For year three is what? It's 125. And for year four is 20. So your total variable cost will be what? For each of the years.
18,720.
18,720. That is 936 multiplied by 20. We have it as equal to what? 18,720. For year two, it will be what?
75712.
1082 multiplied by what? 70 equal to what?
75712.
75712. Can we confirm that again?
75740.
75740.
75740. And for year three,
143375.
so we have it as 143,375. And for year four,
23,860.
Hello, sir.
Yes, ma'am.
Please, sir, before we go far, I don't understand what we're doing here.
Wait, so just wait. You that is talking, I'm not seeing you. Let me know who is talking. So who is talking? Madam Esther. You don't understand what we are doing here, man.
Yeah, this what you just said, this particular space.
Learning investment appraiser. All right.
No, like the demand
This is it.
units. I understood the other parts.
So which one, ma?
This demand unit that we are on.
Okay. Now, this is your variable cost. It's variable cost for 1 unit, ma. Now, how many units do you have? Demand do you have in year 1? What is the number of demand in units? Check your question, ma. I ask you to write it down. In year 1, what is your demand? Yes, very fast. We are going a long way.
20,000.
So 20,000 units. So this variable cost is for 1 unit. The total variable cost for the whole 20,000 is what? 936 multiplied by 20,000. But instead of writing the whole of 20,000, we suspend the other what? The 3 zeros and just write 20. I don't know if you get that.
Okay.
But if you get that?
Yeah.
So 20 multiplied by 936 will give you the total variable cost.
Yes, 18,720.
So is this clear, ma?
Yes, sir.
Or is it from the whole variable cost? You don't understand?
No, I understood all of that.
Okay, fine.
Yeah, thank you.
All right. So 23,860. Now for fixed cost, we should be able to solve for fixed cost, right? For fixed cost, we should be able to solve for fixed cost. Madam Chuma, your hand is up. Any question?
No, sir, it's a former hand.
Okay. So the next is our fixed cost, incremental fixed cost. This fixed cost is relevant because it is incremental in nature, based on the project and on the question, because we've stated that fixed cost is not relevant except where it is specific or incremental. Now, the question made it clear that fixed costs represent incremental fixed production overhead, which are wholly attributable to the project. Now, what is the inflation rate affecting fixed costs? Fixed cost inflation are expected to be what? 5% per year. So our incremental fixed costs will now be what? We have our year. We have year 1, year 2, year 3, year 4. And the fixed costs given in the question in current price likewise. Fixed cost is what? It's given in the question. The value of fixed cost in the question is what?
10,000.
10 million. So suspending the zeros, we have it as 10,000. All true. We have it as 10,000. All true. So now, yes, Mr. Michael.
What I want to say is that is it not wise for us to indicate that 3 zeros up so that the examiner or whoever is looking at it will know that we suspended at 3 or can it be assumed that the 3 zeros are are suspended? And the examiners assume that it has been suspended up without showing it anywhere here?
It depends on how consistent you are in your working from beginning. Yes, but it's better you show it up I'll just show it in bracket here. See it the way I've shown this 1,000 here. You understand?
Oh, okay. Oh, yes, sir. Thank you, sir.
Yes. So the inflation effect. Inflation is at what rate?
5%.
At 5%. So in year one, it will be what? In year one, let me just copy this and
10,500.
yes. So the incremental fixed cost, we'll have it. Incremental fixed cost. We have it as what? 10,500. And for this is what? Should be 11,025. For the third year, 10,000 multiplied by 1.05 to the power of 3. We'll have it
11,576.
11,576. That is Madam Rose.
Yes, sir.
I know your voice.
Good evening, sir.
Good evening. Madam, you joined the class late. I know when you joined this class.
Yes, sir.
So 10,000 multiplied by 1.05 to the power of 4.
12155.
That is incremental fixed cost. So any question about this, please? Any question about this? Now, the next we are to look at, let's see from the question, the issue of working capital. Let's see, because inflation is affecting working capital. Now, 20 million will be needed for working capital. The average general level of inflation is expected to be 3% per year, and working capital will experience inflation of this level. So, based on this information, we need to have a workings for our working capital. Working capital. So, same sequence with what we've been doing. We have year 1, year 2, year 3, and year 4.
Hello, sir.
Yes, ma'am.
Sorry, sir. Please, sir, I can't see your screen.
Okay. I'll reshare my screen. But once you can't see my screen, no, use your network.
Yes, I've logged out and logged in several times.
But can
That's
you
why I
see
have
it? Can you see it now?
no, sir.
Is your network?
Okay.
It used to happen to me too if I'm in a class and I'm not seeing my teacher's screen. So I know it's my network. So, working capital. Working capital. We have the given working capital in the question. In the question is what? Working capital. It's 20 million, right?
20
million.
Yes.
So because we are suspending it, I'll have it this way. So we have it as 20,000 all through. The inflation effect. Inflation is at what? At what rate?
3%.
3%.
3%.
So at year 1, the effect of inflation will be what?
Rest of
At
our
year 1.
zero.
So we have it as, don't mind what I've put down, I will adjust my figures. So 1.03, 1.03. So when you work this way, what will be your incremental working capital?
20,600. No, 600.
Fine. 600 in year one. In year two, what will be the incremental working capital? Wait, let me show the workings. If not, I'll get too many questions. Let me show the workings. Incremental working capital. When you multiply 1.03 to the power of 1 by 20,000, what is the result? What is the result? 20,600, right?
20,600.
Yes.
Minus the gross, minus the actual value of working capital as at year zero. The value of working capital as at year zero is what? 20,000. So 20,600 minus 20,000. What is the increment?
600.
600.
Fine. 600. Because if I should fly like that, I will get enough questions. So don't let me fly. So what you're considering in year one is the addition that inflation has brought in, not the whole 20,600. Take note of that. So when you see question, we saw one question during the last revision class that involved something like this. I explained and explained because students didn't understand the concept of incremental working capital. So in this class, I don't want to explain too much. So let me show it that working capital is a one-off thing. When you are commencing the business, you introduce your working capital. So what you do is that every year you keep turning over your working capital. So when the business will end, you recoup back your working capital as an inflow. As at year zero is an outflow. So as at the end of the year of the project lifespan, it will be an inflow. So this 600 is the effect of inflation on the original value of what? Of 20,000. So that is what we'll recognize every year. Every year. Please take note of that. And it's still an outflow. It will be in jackets when we come to the point where we're going to use it. So in year two, the result will be what?
618.
Okay, fine. 618. How do we get that?
If you do the 1.03 raised to power 2 multiply by the 20,000, when you get, you now subtract it from the other previous 20,600, then you get 618.
So 21,218 minus 2,600. I've explained all this before, but we are showing the workings now. Take notes. So what will be the difference?
618, sir.
Fine, 618. So we're looking at the incremental effect. As at year two, the incremental working capital is 21,218. But it's not this whole 21,218 we will recognize. What is the difference between year two value and year one value based on inflation? The difference will give you the incremental, which is 618. 618. In year three, let me call somebody to give me the answer. Madam Mary, hope you are there. Madam Mary. Okay, I'm confirming those that are in my class. Madam
Excuse,
Christie.
excuse me, sir.
Yes, ma'am.
What about what if we use the just the incremental value to use the inflation rate on the incremental value? I think it will
Fine.
still
Yes, you get same results.
will get same result.
Yes, but why are you getting same result? Do you know why?
No, sir.
Because the cash flows are same for the whole years. You
Okay,
understand? If the cash flows are different, if you do that approach, you will not get it.
okay.
Yes.
Okay, sir.
Because you have 20,000
Mr.
you
Toka,
want.
I'm here.
Okay, man. So, Madam Mary, can you give me
Yes,
the
please.
incremental value for year 3?
154.
Okay.
You said what, ma?
1254.
1254.
1254.
Okay, let's do it together. Let's see. 1.03 to the power of 3 multiplied by 20,000. What do you have?
21,855.
21,855.
21,855
855.
minus the previous, that is
21,
218.
21, yeah. 637.
637. 637. 637. Now, the point is this. In year 4, what will happen? In year 4. In year 4, what will happen? Year 4. Something should happen in year 4.
No, sir.
Yes, ma'am.
So I think we are going to have the whole value because, okay, we are going to recoup the 20,000, then plus the incremental figure of that year 4.
We're going to, yes, recoup the whole working capital. Why?
Yes.
Because the projects have a lifespan of what?
4
4
years.
years.
Of 4 years. So the value of year 0 is what? The working capital of year 0 is what?
20,000.
20,000. 20,000 is an outflow. Is an outflow. So all these effects of inflation, all these inflation effects, you add them. So as at the end of year 4, you need to get it back. You need to get this whole money back. So these are outflows. This is the original outflow. But because of inflation, there is an addition of 600. Because of inflation in year 2, there's an addition of 618. Because of inflation in year 3, there's an addition of 637. All these are arrived at as at the end of the period. So the point is this: as at the end of year 4, the result will be what?
1855.
No,
21855.
22,510.
22. Yeah, exactly.
655.
Is it 22 or 21?
22,000.
21.
21.
21,855.
21,855.
How did you get 21,000?
It's
That is
22,000.
22,510.
1510.
22,510.
22,510.
22,510. That's what it should be.
That you're correct. Is that it?
22,510.
Oh.
We get that.
I have accountants in this class and I'm getting wrong figures.
Size 21,855.
How?
How do you get 21?
That figure is
21,855.
21,855.
21,855.
It's 21,855.
21,855.
You know, one of the things this exam will teach you is to learn to pay attention to details. So, I know it's 21,855, but I know I can be wrong. So that is why I want to hear you first. Because I know I cannot be always, I won't be perfect always. So,
Hello, sir. Hello,
yes,
sir.
ma.
Please, sir, you will explain it because that is the figure for year 3. 21,855 is for year 3. And this is, we are talking of year 4 now. So why are you having 21,855 instead of 22,510? Please explain, sir.
As at year 4, ma, what will happen, ma?
We are going to calculate the inflation rates.
As at the end of year 4, ma, we are recouping back every value of our working capital as at the end of year 4. The relevant years for the working capital, is year 1, 2, and 3. The relevant year for working capital. Because as at the end of year 4, you recoup back the whole value of working capital. I don't know if that is
Does
clear.
it mean, sir, does it mean working capital will not suffer inflation in year 4?
Yes, because we are looking at it at the end of the period, sir. As at the end of that year. As at the end.
Sir, so what would be the value of the year 4?
In year 4, the value will
Hello,
be
sir.
in year 4, the value will be your initial value of working capital of 20,000 plus the inflation increment of 600, of 618, of 637. In year 4, you are getting everything back because the business will end. This working capital is as if you are giving the business the money. You are giving the business the money to operate with. So when the business ceases, you get back your money. Do you understand? So all you've given to the business to run, to function. You understand? So as at the end of that period of year 4, you get it back. You get it back. You get it back. So the relevant years are year 1, 2, and 3 for the working capital. For the working capital.
Yes, sir. Why do you put them in bracket?
Because they are outflows, ma. Working capital, you give money to the business to use to run the business. You understand? That is why they are in brackets. They are outflows. So as at the end of the year, they are no longer in brackets, right? It means what?
Yes.
You are getting them back as an
You have got them back.
Is that clear?
Thank you, sir. Yes, sir. Thank you, sir.
The next working will be what? Our capital allowance. our capital allowance. We want to get our tax savings. We want to get our tax saved on capital allowance. Can you solve that? You should be able to solve that. We use a particular class to solve this. But the person that attempted it actually have done a good job on that. The people that let me go back to see their workings. I checked. It was correct. So tax saved on capital allowance. The initial cost of the asset is what?
120 million.
120 million.
120 million.
120 million.
Okay, 120 million.
So we have capital
Yes,
allowance. I mean, yes.
Now, the question is, what would be the rate of the capital allowance? They say on reducing balancing method.
See,
What would be the rate?
what's the rate?
Where is the question?
I asked you to write it down in your book, man.
25%.
25, Abi.
I have the question. No, it's unclear.
I send it to you in Microsoft Word, man. So
It's
that I will
25.
not get. So how is it 25? Why is it 25?
Because it's for 4 years.
4 years.
Because 4 by 100.
Yes.
100 divided by 4.
No, explain well. Somebody is not getting it.
Hello, sir.
Yes, I'm with you.
Okay, sir. Since the project's lifetime is 4 years,
Yes, ma'am.
so we have to divide it by 100,
All
which
right,
will
ma'am.
give us 25.
All right, ma'am. Yes. So by the time you go to the hall and you are looking for the rates to use on your capital allowance based on reducing balancing basis, they will not give you. It's not every time they will give you. It's not every time you get
Just calm
everything
down.
clear. Because you go there now, you say the question is not correct. So for you to get the percentage, the project lifespan is what? It's 4 years. So since it's 4 years, 100 divided by 4 will give you the percentage you achieve. We explained this while we were talking about the issue of capital allowance in one of our classes. So they will not always make everything available. Yes, and that is the essence of this class, so that you always see things beyond what is being put down in the question paper. So now, year 0, the cost is what? Year 0.
120 million.
Okay, costs is 120 million. I'm suspending the zeros. So we have it as 120,000. 120,000. As at year 1, what will be your capital allowance?
30,000.
Capital allowance. At what? 25%. It will be what?
30,000.
30,000. Your tax written down value will be what?
9,000.
90,000.
Okay, 90, sir.
So your tax savings will be what?
9,000.
That is 30% of what? Of your capital
20,000.
allowance. So we have it as equal to what? 9,000. In year two, the capital allowance will be what?
22,500.
We have it as what? 22,500. So your tax saved will now be what?
6,750.
30% of 22,500 will be equal to what?
6,750.
6,750. So your tax written down value will now be what?
67,500.
67,500. In year three, your capital allowance will be what?
16,875.
16,875. 16,875. Your tax saved will be what?
5,063 approximately.
875 equal to what? 5,000
and 63 approximately.
tax written down value will now be what? Let me go and see one of the solution. Let me see one of the solution forwarded solved. Let me see. No. Calculation of past savings. Okay. Let me go. Madam Odunayo, you didn't forward your solution to the platform. Let me go and look for your own. Let me see. So in year 4, what will happen? You know, I think there is a question somewhere. Let me see. Yes, Madam Christy, what is your question?
Good evening, sir.
Good evening, ma'am.
Thank you so much. Yes, sir. I'm so sorry for taking you back. And then I didn't start the class when you people started. Not today, I mean maybe 2 days ago. So maybe, sir, I would like to see the timetable so that I can prepare my schedule towards it, so I won't be missing the class. I really enjoyed the class. Thank you so much. So my question goes thus. And I don't know how are we going to know that we are going to use this type of method for capital allowance, the 25% that we are using and the 30%. So I don't know, how do we arrive at it? Apologies, sir.
Yes, it is stated in the question that using reducing balance method. So in our normal financial accounting, financial reporting, this is a reducing balancing concept. So the tax savings, the 30%, the tax element or the tax rate given in the question is what you use on your capital allowance. And why are you using it? That instead of paying the tax of what? Of 30,000, you enjoy a savings of 9,000. Do you understand? So the essence of this capital allowance, tax save on capital allowance, is to reduce your tax burden, to reduce the tax you have to pay. Since you've invested your money in an asset, so you enjoy certain tax incentives, which is capital allowance. So the 25%, how we come about it, if you go to the question, you will see a point in the question that says that capital allowance There is tax allowable depreciation on a reducing balancing basis. Reducing balancing basis, and could be claimed on the cost of the equipment, and profit tax of 30% per year will be payable 1 year in arrears. So the tax rate given to you in the question is 30%. So what will be the tax savings on your capital allowance? Will be 30% of the value of your capital allowance, right? So this capital allowance is otherwise known as depreciation in our normal financial reporting, financial accounting, but in this case, based on tax issues, we refer to it as what? Capital allowance. So the class for FM is always Fridays 6 to 8, Sundays 5 to 7. For PM, when there's an PM class, PM is Tuesdays 6 to 8 and Saturdays 6 to 8. That is the time.
Sorry, sir. Come again, sir. It says Saturday 6 to what?
6 to 8 for PM.
6 to 8. Okay. So if I may get it, you said PM on Tuesday 6 to 8 and a Saturday 6 to 8.
Yes, ma'am.
All right, sir. Thank you, sir.
FM Fridays 6 to 8, Sunday 5 to 7. So is the explanation on this method of depreciation clear to you, ma'am?
Yes, sir. Thank you so much, sir.
So you can watch the videos again. In case you don't have them, just reach out to me. Then I will
Oh, thank you, sir.
forward them to you.
Thank you, sir. God bless you.
Amen. So the issue of the fourth year. In the fourth year, what will happen?
It becomes scrap value.
In the fourth year, the scrap value. The scrap value will be what? It's given in the question, right?
0.
0?
10 million.
And Macaulay, you didn't read this question.
I don't have it. The one I printed is not clear.
I took my time to type this question this afternoon and forward on Microsoft Word to the group so that I won't hear this kind of question or this kind of
I didn't see
complaint.
anything. I just saw it when we have started the class.
I will not have print at home to print it.
My laptop is not connecting, so I can't get it on the this. I'm
Okay,
sorry.
it's fine, no problem. So the scrap value will be what in or the tax written down value in year 4 will be what?
50,625.
Minus 10, the disposal, the expected disposal at the end of 4 years. That's 10 million.
$50,625. 625. Our scrap value is what?
10 million.
Please, how did we get this 50,625, please?
67,500
minus 16,875. Sorry.
Thank you.
Is that clear, sir?
Yes, sir, it's clear. Thank you so much.
I'm looking for the solution. One of the students forwarded to me. That is what I'm looking for. So now, in the 4th year, what will happen in the 4th year? In the 4th year, we have our tax written down value to be 5625. The scrap value is what?
10 million.
10 million. Is in the question. It's not manufactured. Let's go to the question and see it. Says here that the equipment is expected to be sold at the end of 4 years for what? 10 million when production and sales cease. So 10 million. Scrap value. The scrap value is 10 million. So it's an income, isn't it? It's an income.
Yes.
So
Yes, sir.
what is an income? Is an income.
Hey, well, my phone is 1%.
So it's an income. So let me do something here. Scrap value. So what will be your capital allowance? Your capital allowance for that 4th year. I want to know.
Is it the balancing charge? I didn't get all your points.
Yes. Yes.
Okay. Because the sales proceed is higher than the tax written down value for the year. So we are going to have balancing charge.
So what will happen to balancing charge?
It's an inflow.
The balancing charge. So when you have your tax written down value less than your sales proceed, it is what?
Balancing allowance.
When your tax written down value,
Okay, it's less than, oh, that's balancing charge.
when your tax written down value is less than your sales proceed, it is what? Balancing charge. When your tax written down value is greater than your sales proceed, it is what?
Balancing,
Oh.
So it's balancing allowance.
Yeah, balancing allowance.
Balancing allowance.
Balancing allowance. Balancing allowance. Balancing allowance. So what will happen here? Let me just you can do it in a way, in 2 different ways. Let me just show it this way. The scrap value. Let me show you this way. Let me get this. So scrap value. The scrap value is 10 million. That is 10,000 here. Now, to get your capital allowance, what will you do? The difference between your tax written down value and your scrap value. What is the result? The difference between your tax written down value and your scrap value will give you what?
46.5.
14.
4625.
4625.
625.
4625. So this value 4625 is what?
It's a balancing
allowance.
Is balancing allowance. If you still put your 10,000 here, you still get same result. Take notes. I'm just to. That's why I was trying to look at the solution the other person forwarded. Balancing allowance. Now this balancing allowance, and if you say 5625 minus 4625, you get what?
10,000.
So this is your scrap value. This will be your scrap value. You understand? So 5625 minus. So we did a walk back. You understand? Your scrap value 5625 minus 10,000. We give you what? Your balancing allowance here. So this balancing
Correct.
allowance, the balancing allowance, will it enjoy tax savings? The balancing allowance.
Total.
Yes, sir.
So what will be the tax savings?
12,188.
12,188.
So we can have this in bracket too.
Please, how do I know that the balancing allowance will have a tax savings, please?
Balancing allowance enjoying tax savings, balancing charge does not. So we explained this in our previous class that once you have an allowance, balancing allowance, once your tax written down value is greater than your sales proceed, that is a taxable profit. But where your tax written down value is less than your sales proceed, is not a taxable profit. So it's a loss rather. So it will not enjoy savings. It will rather be carried forward. Yes. The loss will be carried forward. So once it is an allowance, that is your tax written down value is greater than your sales proceeds, it enjoying tax savings. Is that clear, sir?
Yes, sir, it's clear, sir. Thank you so
I
much.
have a question.
What is the question, ma'am?
Sir, you know, when we treated Juliet Limited, whatever, the 4th year we calculated capital allowance. But this particular one now, you didn't calculate capital allowance on the 4th year. I want to know why the difference. Why are we not calculating capital allowance on this particular question?
There is capital allowance. I didn't put the 4th year. See it. I'll put it. See it. This is year 3, right? This
Yes.
is the last year.
No, that's not what I'm saying. For example, after the year 3 that we got 50,625 naira, we would charge that 50,000, 25% of 50,000, 625,000. We get to about 12,000 something like that. That's what I mean.
Yes, I think in that question, it was stated that they didn't give us scrap value in that question.
Yes, sir.
Fine. Scrap value was not given to us. Please, you can mute yourself.
Okay.
So in that question, we're not giving scrap value. And it was stated, if I can recall, that it was stated in that question that the value, the balancing allowance as at the last year will still remain as the value of the, should be used as the scrap value. Should be used as a scrap value. I don't know if I can access the question now. So since we're not giving scrap value in that question, we computed tax savings, isn't it? As at the 4th year. I don't know if that is what you're
Yes,
trying
sir.
to.
We computed it for the 4th year.
Yes. So in this question now, are we not computing tax savings for the 4th year? In this question, for the 4th year, we are still computing our tax savings. I don't know if that is what you are trying to ask.
But yes, this particular question now, we are computing for tax saving, but we did not charge the capital allowance. Unlike the form that July PSC that would charge the capital allowance on the 4th year.
A balancing allowance is capital allowance too, madam.
This is the capital allowance also. This is it. I don't know if you get.
Okay, sir.
This is it. And that is why you can see it in. Thank you for understanding our question, sir. I didn't get. Yes. Adamineka.
Hello, sir.
Yes.
So I just wanted to confirm, because sometimes this balancing allowance and balancing charge is some kind of confusing. So I just want to know, this balancing allowance is it a loss? Is it like a loss? The balancing charge is a profit.
The balancing allowance is a profit. Balancing charge is a loss. Balancing allowance can mute yourself, please.
Excuse me, sir. Sorry, but here now they made loss.
This is the point. The issue of balancing allowance. The carrying amount. This balancing allowance is the carrying amount in your book of accounts. So this balancing allowance, when your carrying amount from the preceding year, from year 3, is higher than the sales proceed, is higher than this scrap value at the year of disposal, it is termed as what? It is termed as what? As a taxable profit. I don't want to use the word taxable profit before, but I have to use it now. It's termed as what? Taxable profit. Now, this allowance, what is this allowance? This allowance is what? Yes. When you talk about this allowance, what is this allowance all about? The carrying amount, see it here. It is, you are seeing it as if you said it's a loss. So how is it a loss? That is where, thank God I didn't do it the other way around. So how is it a loss? If I might get you right now.
So when I said it's a loss, as in the angle I'm seeing it is that the tax written down value is 50,000, and now they now sold the equipment at 10 million, like 10,000.
Yes.
So they sold it lower than what the asset is worth. That was why I'm saying is a loss.
Okay. It's not a loss. So what is balancing allowance? Balancing allowance. Yes. Very fast. From what we've done.
Balancing allowance is when the tax written down value is higher than the scrap value.
So how do you get your balancing allowance?
That's the tax written down value. You less it from the scrap value.
So this balancing allowance is like depreciation. You understand? Your depreciation as at the 4th year is what?
40,625.
Very good. So if your depreciation have overpowered your carrying amount, what has happened?
Okay, so I've understood it.
So I believe you know the concept of impairment, right?
Yes, sir.
Fine.
Thank you, sir.
And thank you for asking the question. Yes, I can see. Yes, Madam Victoria.
Yes, sir. Well done, sir.
Thank you, ma.
My question is, sorry, I came late.
Yes,
I'm
I saw
just,
you, ma. I'm just waiting for you to ask a question.
I'm sorry, I want to take you back, sir. It's just a question.
Okay, ma.
I'm always getting confused when it comes to the inflation rate.
All right, ma.
Not knowing the year to start, whether you're 0 or year 1. The previous class you told us that when it is year 0, we start from year 1. When it is year 1, we start from year 2. But when I came in, like someone was asking that question, and you told the person that where they are stated in the current price, inflation must be that year.
All right, ma. I'll repeat
Okay,
myself again.
sir, let me come in. Sir, I'm not done, sir. Wait, sir. So when I
Okay.
saw the question now, so I was trying to read and read and read. Where is it stated as the current year, sir? I don't understand. I didn't see any current year.
All right, ma. It's fine,
Okay.
ma. So let's go back to the question. Ma, can you see this table, ma?
Yes, sir.
Can you read this highlighted point, ma?
Selling price in current price times.
Yes. In current price terms, translate to what?
Oh, current year.
Good, ma. And when it is stated in current year, what is the implication, ma?
Okay. That means that we use that year.
Very
It
good,
will
ma.
not be carried forward. Okay.
So, but when it is stated, when the question states that cash flows are stated in year 1 prices or first year prices, what will now be the treatment, ma? It means you start in year 2, ma.
Okay, sir. Okay, sir.
So
Okay, sir.
you go back to the note, ma. I don't know if you have the note, so that you will get that very well and let it be. It's very confusing. So you asking the question is not out of place. It's actually confusing, but you need to sit down and look at the statement and interpret it as appropriate.
Okay, sir. Thank you,
Yes.
sir.
So you need to do that. So yes, please. I think if I've answered your question, just put your hands down. I have time constraints. We need to, if not, we'll not complete this question. It's a very lengthy one. Yes. Who is still having question? Tokwe, what is your question?
All right, so I want to cohort with what Madam Chikodili asked earlier before, because in the previous example that we treated, the same asset as 4 years, and it was after we calculated the capital allowance at the 4th year, and we got our tax written down value. That was when we now deducted our sales proceed, even though it was 0 in that question. So in this question right now, I was thinking it should be the same, that we'll calculate our capital allowance 25% of 50,625. Then to get our tax written down value, then we now deduct our sales proceed to get our balancing allowance. So I don't know why we are not calculating capital allowance on that 50,625.
25% of 5625 is what?
Is 12,656.
Okay, 12,000. 12,000 what?
656. 656.
Okay. Yes. It is so, because in that question, because we're not giving the scrap value. But in this case, we're giving the scrap value. And that is the difference. Yes. In that question, as I've said, that scrap value was not given. So scrap value was what? or 0. Isn't it?
Yes,
Yes,
sir. The
value
scrap
was
value
0.
was 0.
Yes, scrap value was 0. But in this case now, you are giving your scrap value. It means anything you are doing from the beginning, you should work to get what? Your scrap value. You should work to get your scrap value. So that is it. Is that fine?
Yes, sir.
Yes, sir.
So we have to move very fast now. So the last workings I will show is the issue of what is it called now? This Washington PLC has a real cost of capital of 7.8%. You can see that our cash flows, since they are affected by inflation, they are what?
Money
What kind
cash
of cash flows do we have?
money cash flow.
Money cash flow. So this real cost of capital, can we use it against money cash flow?
No.
No, sir.
So it is no. It is a no now. So now, what are we going to do? What are we going to do?
You have to work for
To
money.
convert money cost of capital.
Fine. We convert. It will now, let's say, calculation of what? Of money cost of capital or discount rate. Money cost of capital. Money cost of capital. So the formula is what?
The formula is R equals to 1 plus R divided
M
by
equals to
No. 1 plus R times 1 plus
bracket 1
R minus 1.
The formula is you said 1 plus what?
M equal to 1 plus R bracket times 1 plus I.
1 plus I. So now we want to get the value of M, right? We want to get the value of M. So this formula can just be 1 plus
1 plus R
multiplied by 1 plus
1 plus I minus 1.
Minus 1.
Yes, minus 1. So your M will be equal to what? 1 plus what? The given rate cost of
7.5%.
7.8%, man. So it will be 1 plus 0.078.
1
In relation to what?
1.03.
Okay, fine. 1.03. The 3 is the general inflation rate given in the question, in case you are wondering where we get it.
Minus 1.
Okay, minus 1. So to now be in this form, M will be equal to what?
7%.
1.078 multiplied by what? 1.03 minus 1.
11%.
So M will now be equal to what?
11%.
11%.
11%. Hope this is clear. Hope this is clear now.
Yes, sir.
So very quickly, I'm just going to solve for MPV. Once I solve for MPV, the other ones are just is what you can solve on your own. Calculation of net present value. Calculation of net present value. That is NPV. Calculation of net present value. Let's see now. Net present value. So we can have our year. We have 0, 1, 2, 3. We can have year 4. We can have 5. The question stops at year 4, but because of one reason, we extend it to year 5. And what is that reason? You should know. Tax, fine. So we suspend all this. Suspend this. Have it. So based on the elements we have cells, right? Because we need to work to get our net cash flow. We have cells, isn't it? Your cells in year 1 is what? Based on your workings.
42 million.
42,000.
And for year 2,
169820.
169820. All right, let me correct what I have here. And for year 3,
231,500.
and for year 4,
36,460.
460. Less our variable costs. Variable costs. Less our variable costs. For year 1, the variable cost value is what?
18,720.
For year 2, it is what?
75740.
75740. For year 3,
143,425.
143. Is it 375? I'm not mistaken. And for year 4, please confirm that, sir.
My approximation.
143,370.
So 20 for this year 4. What else are we going to consider?
Fixed cost.
Fine. Incremental fixed costs. Incremental fixed costs. And the value is what for year 1? For year 2. Let me see. I think this is for year 1, 10,500.
10,500.
For year 2,
11,025.
for year 3,
11,576.
and for year 4,
12,155.
what else again? Can we determine our profits? For year 1, the profits will be what? 42 less 18,720 less 10,500. For year 2,
12,780 year 1.
for year 3, year 4. Please confirm my figures, please. Then we have taxation. Taxation is at what rate?
30%.
30%. You know, tax is paid in arrears, right? So the tax of year 1 will be paid in which year? In year 2. So what is the tax of year 1? The tax of year 1 is what?
The tax in year 1.
12,780 multiplied by 30%. It will be due in year 2. That of year 2, 30% of 83055 will be due in year 3. What will be the figure?
76,549 times 30, 100. 22965. 22965.
Okay, all right, sir. 22965. So that of year 4 will be due in which year? Year 5. And the value will be what? The value will be what?
134.
134.
134.
So what else are we going to consider?
Sir, please check your tax value for year 2. I'm getting 24,917. Please confirm.
Somebody else should confirm, please.
Yes, 24,917.
Okay. $24,917. All right. So the tax savings will now be what? Tax saved. Go in line with the tax payments. Take note. The tax saved for year 1 is what? From our computation.
9,000.
So for year 1, it will be in year 2. For year 2.
6,750.
And for year 3. Come in year
50.
4. 5 what?
5063.
And for year 5.
12188.
As at the 4th year, we experience something in terms of the assets. As at the 4th year, there is an inflow. What is that inflow? The inflow is from where? The disposal of the assets.
Yes, sir.
Scrap value. The 4th
10
year. So the value is what?
10 million.
That's 10,000.
Mm.
What else are we going to look out for? We can have our initial outlay now.
I think we should get the total to get our profit. Taxes.
We've done that, man.
Okay, sir.
We are heading to getting our net cash flow now.
Yes,
The
sir.
initial outlay as at year 0, based on the investment,
125,000.
120. What else again as at the initial period? We have our working capital. The value of the working capital is what?
20,000.
20,000.
Now, in year one, do we have any issue of working capital?
600.
In year two,
600.
in year three,
637.
637. 637. In year four, what is the result?
21855.
21855.
Yes, 21855. So what will now be your net cash flow now? The net cash flow will now be what? For year zero,
40,000.
140,000.
140,000. For year two, it will be what? 12,780 minus 600. Going to have what?
12180.
Inflow. In year two, it will be what? Year two, 83055 minus 3834 plus 9,000 minus 618. You have what?
87603.
And in year three, it will be what? 760 76549 minus 249137 plus 6750 minus 637. You have what?
57745. 57745.
And for year four, it will be what?
It will be year 4. Okay, plus 21855.
14398.
14398.
And year five, we have what? 12187 minus 134. 005. So what are we now going to do? We discount our cash flow. The discount factor is what?
11%.
Discount factor at what?
11%.
11%. For year zero, it will be 1. As at year 1, the discount factor of 11% will be what? Based on year 1. For year 1, what is your discount factor? For year 1, I'm still waiting. Your discount factor is what?
0.901.
No. 10974.
No, you are giving me the
10974.
final. Okay, you are giving me the final figure already. I'm still out. Though I put them down, but I still want to get to hear if what I put down is correct.
Yeah,
So your present
0.909.
909 Yes, can I get confirmation?
01.
0.259.
901.
0.259.
For which one, ma? So the present value for year 0 will give us what? 1 multiplied by 140. We have it as 140. For year 2, 0.901 multiplied by 12,180 will give us what?
10974.
974. And for year 2, it will be what? 0.812 multiplied by 87603.
71134.
And for year 3, it will be what?
42,211. 42,216.
Then for year 4, it will be what? 14,398. And for year 5, it will be what? 12,053 by 0.593. Yes, what is it?
Negative 956.
Okay. What is the question, ma?
Thank you, sir. For year 1, my calculator is giving me 0.909. And for year 5, my calculator is giving me 0.621. How do we
Madam
get
Ruth. Madam
0.901?
Ruth. Madam Ruth, what did you have? What did you have, ma?
0.901.
Okay, just tell us how you punch your calculator.
Okay.
Yes, Madam Ruth.
Okay, I normally use shortcut. 1 divided by 1.
Okay.
1 divided by
Let
1 equal to 1 divided by the other one.
Okay, this is it. Let me explain now. Ma, on your calculator, 11% is what, ma? 0.11.
0.11.
So 1 plus 0.11 is what, ma? 1.11, right?
Oh. Oh.
It's 1 over 1.11.
Sorry.
Raised to
Thank
power
you.
of.
I pressed 1.1. Sorry.
All right, fine.
Raised to power of.
So now, to get our net present value, what are we going to do? Net present value will be equal to what? Now, add these whole positive values. What will be the result?
14956.
14956 minus 140 to give you what?
956.
Your NPV is 956. This is what I want you to do based on requirement 1. That you should calculate NPV, right? Then that you should calculate internal rate of return. So how are we going to calculate our internal rate of return? We need to look for 2 discount factor, right? But in this case now, you don't need to look for 2 discount factor again. Since you have 11%, right? And it's giving you a positive NPV. What you need to do is to look for another value that will give you a negative NPV. And what can you do? Is it to increase or reduce the discount factor?
Increase.
So let's increase this to 15% for us to get our internal rate of return. I wanted to stop here before, but let's just quickly show that. So for the other parts, there is calculation of internal rate of return. Internal rates of return. Calculation of internal rate of return. Let's assume 15%. Assume 15%. So what are we going to use as our cash flow? That is the key point I want to get from you now. What are we going to use as our cash flows? Once we get that, and that is all.
Net cash flow.
Very good. Net cash flow.
Net cash flow.
Year 0, year 1, year 2, year 3, year 4, and we have year 5. So now, still suspended in thousands. Suspended in thousands. So the net cash flow in year 0 is what? Okay. In year 0, net cash flow in year 0 is 140, right? Let me just copy this. So now, the discount factor is what?
15%.
At 15%. So at year 0, we still have it as 1. In year 1, 15%, what will be your discount factor?
0.86 or 0.870.
In year 2, we'll have it as what?
0.756.
In year 3, to be, and in year
0.658.
In year 4. Madam Macaulay, are you still in this class?
So I'm in the class, but today's class get as it be.
It didn't get as it
I'm
be.
in the class.
See, I get as it be.
Get as it be. The class. One question. How many hours person go take answer this question now?
Is that what is? It's because we are teaching it now. If you are to solve it, on your own, you will know how to manage your time.
I don't know. Maybe the reason I'm not really flowing is I'm tired. I'm really worn out today. I don't know.
Yeah. Sorry, ma.
Thank you, sir.
So your present value will not be. I'm not hearing your voice again. So it's a call for.
I know you will ask now. I don't want to say something wrong. A wrong thing. That's why I just keep quiet.
So when you rest, then you go back to the videos again. You understand?
Thank you.
Yes,
Thank you.
So your present value as at year 0 will be what?
140.
140. For year 1, it will be what?
105,966.
Year 1, your present value?
105,966.
0.870 multiplied by 12,180.
10,597.
10,597.
10,597.
And
6,
for
2,
year
8.
for year 2,
6, 6, 2, 2, 8.
for year 3,
3, 7, 9, 9, 6.
and for year 4. And for year 5.
Excuse me, sir. The year one is wrong. The
It's
PV is
correct.
10,527.
Any confirmation to that?
It's correct.
No, it's correct.
It's not correct. It's supposed to be 10,925.
It's correct.
It's wrong. 12,180. We are using our net cash flow.
It's
It's
correct.
correct.
Yes, it's correct.
Abel, help me tell your husband, say the person when they
It's
carry
correct.
something to come Calabar. May tell that other person, say you go
Let's
come.
mute your mic.
When they come in,
Madam Ruth, abeg, your Calabar delivery.
Wow.
Sorry, I've muted her.
Sorry, she's correct, my dear. So she's correct.
For year
You
5.
know, one thing this exam will teach you is to pay attention to details. Yes. So if we are saying it's correct, it's not correct, me, I will just be looking. If you give me the wrong answer, I'll write it there. Me, I have my right answer now.
Answer is correct.
So what will be your MPV here? Yes, Madam Joy.
Sorry, I want to take us back a little bit. This discounting this year at 15%.
Yes.
Sorry, how do you arrive at the 15? I know there's an
In the
11.
concept of when trying to solve internal rate of return, you assume two values, two discount values. You understand? So
Yes, sir.
once you assume two discount value, if you use 5 and you have a positive NPV, you assume another discount factor by increasing the 5 to like maybe 10 so that you can get a negative NPV. You understand? So when you get this result, you now substitute into the internal rate of return formula. So this 15 is just an assumption. If you check my write-up, let me see. I think I put assume. Do you see? Assume 15%. You can assume 20%. You understand? But don't allow the margin to be too far from each other.
Too much. Okay, sir.
Do you get?
Thank you.
When have you started? See how she's making her hand like Europe.
Who is making noise again?
Rose.
Rose.
You know, when the noise is too much, when you are listening to the video again, you say, what kind of class is this? So now the MPV will be what here?
10,953.
Negative, right?
Yes, sir.
10,953. So what will be the next step? Your internal rate of return formula.
We use our formula. We get our MPV.
Your internal rate of return formula. The formula is what?
MPV
Plus MPVA over MPVA minus MPVB multiplied by B minus A.
Okay. So we now have it as what? MPVA plus MPV
Mhm.
So looking
So
at this,
this,
when you substitute your values, this is the internal rate of return formula. Now, what is A? What is A? What is it that
level.
Lower rate. Lower rate.
A is the lower rate? Take note. A is the lower rate, and the lower rate among the two values we've used is what? It's 15. 15. So A is 11. And what is MPVA? MPVA is what?
956.
That is MPV of what?
Positive
The
MPV.
lower discount rate. That is 956. And this is what? This will be 956 likewise. Take notes, before this plus, there is a minus, because there is a minus. The original formula is minus, but minus multiplied by the negative result of this, we change it to positive, and that is why we have plus. So the MPV of B is what? MPV of B is
10,953.
10,953.
953. 10953. Take note, is negative, but when you multiply negative by negative, it's changed to what? To plus. And that is why you have it this way. So this is what? Your B is what? The higher discount rate minus the lower value. So when you simplify this, what will be your
What will
result?
be your result? 11%.
Who is getting 11%? Or who is not getting 11%? Is this clear, please?
Yes, sir.
So can we
Yes, sir.
calculate the payback period? This will be discounted payback period now, because though what you just need is your cash flows. Yes, in the first year, year zero, you gave out how much? 140,000, isn't it? So in the year one, you have an inflow of how much? 10,974. In year two, so that 140 will keep reducing. So can you compute the payback period? Let's see. Can you compute the payback period?
Please, I don't understand what you just said.
The
Hello, sir.
payback period. Yes, ma'am. It's you, ma'am.
You said, I didn't understand what you are just saying.
All right, ma'am. So for you to compute your payback period, you need to use your present value to compute your payback period, your present value. So this payback period, let me just lay the foundation. And lay the foundation now. See. So we can have a year. We have year 0, year 1, year 2, year 3, year 4, year 5. Then still values suspended. Now, your present value is what? For based on your computation. The present value is what? Is what you have to use. Determine your payback period. So this is your present value. As at year 0, what is your balance? As at year 0.
Minus 140.
Minus
Sorry, that present value is here on 11%.
Yes.
What is the present value is on 11% based on the cost of capital used in the question. You understand? That is
Okay,
the
sir. Thank you, sir.
capital. So the present value, as at year 0, the balance is what? 140. Now, you gave out 140 as at year 0. You have an inflow of 10,974 as at the end of year 1. What will be your balance as at the end of year
129,026.
129,026? Sorry, let me write.
Sir, you don't have discounted payback.
Yes, this is discounted payback here.
Are we
Because
not considering the discounting factor?
No, you've already discounted now using your 11%, sir. The discounting factor given, sir, in the question is 11%, right?
Yes, sir.
That you solve for. So you use that 11% to discount your net cash flow to get your present cash flow, isn't it? Isn't it, sir?
It is.
All right, sir. Payback period. So now, as at the end of year 2, what will be your balance? You have an inflow of 71,134. When you deduct that from this, the result will be what?
Madam Rose, can you mute your mic?
57,892.
57,892. Then, as at year 3, the end of year 3, you're able to obtain a cash inflow of 42,212. What will be your balance when you subtract from 57,892?
15,680.
So as at year 4, what will happen?
We still have
That
balance.
6192.
92.
6192. 6192. That is your balance as at the end of year 4, right?
Yes, sir.
So based on this, what will be your payback period? So when you, what will be your payback period? Because this balance, when you come to year 5, you can offset this balance, right?
Yes, sir.
And you still have remaining balance. 7148 minus 6192. You have what?
956.
It means that for you to exhaust 6192, you don't need the whole of the year 5. You don't need the whole of year 5. before the end of year 5, you should be able to exhaust to get money that you pay back that balance. That is the implication. So based on this now, the payback period will be what? From what we've done in the first class.
It will be 4 years, 10 months.
Okay. How did you get that, ma'am?
So I divided the 619 divided by 7148 and I times it by 12 to get the months.
Okay, fine. You can still have it this way: 4 plus divide by 7, 1, 4, 8. So when you do this, what will you have? When you divide 6192 by 7148, you're going to have what? 4 point what?
4.866.
4.66, that's 4.9.
4.9. So you can have your answer this way likewise. 4.9. Ineka, what did you give us as a result? 4 years.
4 years. I got 4 years, 10 months.
Okay, so you multiply
By 12 months.
What do you
to get the
multiply
number
by
of
12?
months. Yes, sir.
What do you multiply by 12?
To get the number of months.
Yes, I understand.
understand.
So
So
6192 divided by 7148. You have 0.866. Multiply by 12, then you have your 10. Yes. So you can have it this way: 4.9 years. You understand? You have it 4.9 years. That is, you can also do it the way she has done it. That's decimal, you multiply by 12. All is fine. So is this clear, please?
This thing, according to the rule, it is not worth taking.
Yes, it's not worth taking. Yeah, very fine. Because the contract will elapse, will just last for how many years? 4 years. But for you to get your money, it will be beyond the 4 years period. So it shows that based on paper period is not a good one. So, but based on MPV, what would be your advice?
The project is worth it. Since we have a
The
positive
price should be
end.
accepted.
Yes, the
Because
project
it's
should
a
be.
positive.
Yes, because you
We
have a
accept it.
positive MPV, a positive MPV. So based on what we've done, what are the assumptions you've come up with? What are the assumptions you've worked with? What are those things you worked with?
I think one of them is the tax, the payment of tax in areas.
Okay, fine. Yes, what are the other items?
The
The issue
inflation.
of, yeah, fine.
The issue of
Depreciation is a non-cash item, so it is irrelevant in your calculation of MPV. The issue of
The
development
sunk
cost,
cost.
yes. So all those issues: development cost, testing cost of 8 million, market research cost of 2.5 million, they were past costs and therefore what? Irrelevant to the calculation of MPV. So what other thing? Your incremental fixed cost. It is assumed that the incremental fixed cost will not change within the relevant range. So Once you see a question like this, just go to the question itself and pick your answers and write your answers out. So don't leave theoretical questions like this and let it go. It's a way you can get your additional marks to make you cross 50. So based on the question, that's what, let's see.
Sorry about what you said about incremental cost. Can you explain again? I didn't get that part. Incremental fixed cost, sorry.
In the question, it was stated that incremental fixed cost is incremental. So, and the level at which it's increasing. The value of fixed cost given in the question is what? Is 20,000, right? Or what is the value? The value of fixed, the value of fixed cost given, that's 10.
10,000.
So it's that it is assumed that it will not change within that range, within that period. But what will affect it is what? Is inflation. Is inflation. So that is what we are saying.
Yes, but sir, there's inflation there now.
Yes, inflation is constant. Inflation is constant. So, but based on what is given, based on the current prices, it is constant within the relevant range. It's constant within the relevant range. But incremental fixed cost, and it seems it is incremental. It shows that inflation is affecting it. Is affecting it, and is an assumption that has been made in the question. But in real life situation, we all know that most times fixed costs will not be relevant. So this is an assumption that has been made. So within the relevant range, yes, you might see that it is 10, 10, 10, 10, 10, 10. But the additional information is now telling you that it is incremental in nature. And the fact that it is incremental in nature is as a result of the effect of taxation on it. So it's that element of tax that is now making it incremental. So those are some of the assumptions you can have in the question. So that's what are your assumptions on the calculation above. So that is it. So there are other questions you can attempt related to this. If you have time, you don't have time, that is left for you. The point is, I don't want to hear stories when result is out. My own concern is you have to pass. When you come and tell me story, I don't need story. I don't need story.
By God's grace, amen.
When you remember that I don't want story, you have to read. So the story is no one story. I'm giving you my own story now. So there are many questions you can attempt. These are questions you can attempt from the compiled question and answer. Many questions. Some persons are almost through with this material, solving it till the end. So if you are still sleeping at midnight, except you have a health challenge. If you have a challenge, please sleep. But if you are still strong as I am, you need to make sacrifice. So, but if you have a challenge, please sleep, Biko. I beg. It's when you have life, you come and say you are reading for icon. So you can see some of the examples you can solve as it goes gradually. We move to the zenith. Yes, one of the questions I sent as assignments is also here with the solution. In case you've not solved, you can you can solve to test your understanding. So you can, for those of you that still have issue of tax savings and the rest, you can also make attempts. So this is a broader question looking at relevant cash flows in relation to purchase of machines. So we have these also. So you can, if you have it, you can solve. So investment appraisal using discounted cash flow method. So you can, in case you don't know how we are getting those discount factors, this is one way you can learn that. So class, next time we are meeting, we are discussing something else by the grace of God. As far as this topic is concerned, my own is for you to go and be solving questions. So that is that for tonight. Thank you very much.
Thank you, sir.
Yes, sir.
Thank you, sir.
Solve this question again. Thank God.
Okay. Thank you, sir. Thank you, sir.
Thank God.
Thank you so much.
God bless you, sir. God bless you, sir.
God.